Selling cash-secured puts on stocks an investor is happy to take ownership of is a great way to generate some extra income. A cash-secured put involves writing an at-the-money or out-of-the-money put option and simultaneously setting aside enough cash to buy the stock. The goal is to either have the put expire worthless and keep the premium, or to be assigned and acquire the stock below the current price. It's important that anyone selling puts understands that they may be assigned 100 shares at the strike price. Why trade cash-secured puts? Selling cash-secured puts is a bullish trade but slightly less bullish than outright stock ownership. If the investor was strongly bullish, they would prefer to look at strategies like a long call, a bull call spread, or a poor man's covered call. Investors would sell a put on a stock they think will stay flat, rise slightly, or at worst not drop too much. Cash-secured put sellers set aside enough capital to purchase the shares and are happy to take ownership of the stock if called upon to do so by the put buyer. Naked put sellers, on the other hand, have no intention of taking ownership of the stock and are purely looking to generate premium from option selling strategies. The more bullish the cash-secure put investor is, the closer they should sell the put to the current stock price. This will generate the most amount of premium and also increase the chances of the put being assigned. Selling deep out of the money puts generates the smallest amount of premium and is less likely to see the put assigned. MO Cash Secure Put example. On Friday, with MO trading at $50.48, the June put option with a strike price of $50 was trading around $3.40. Traders selling this put would receive $340 in option premium. In return for receiving this premium, they have an obligation to buy 100 shares of MO for $50. By June 17, if MO is trading for $40 or $30 or even $10, the put seller still has to buy 100 shares at $50. But, if MO is trading above $50, the put option expires worthless, and the trader keeps the $340 option premium. The net capital at risk is equal to the strike price of $50, less the $3.40 in option premium. So, if assigned, the net cost basis will be $46.60. That's not bad for a stock currently trading at $50.48. That's a 7.69% discount from the price it was trading on Friday. If MO stays above $50, the return on capital is $340/$4,660 equals 7.3% in 95 days, which works out to 28.03% annualized. Either the put seller achieves an 28.03% annualized return or gets to buy a high-yielding stock for a 7.69% discount. Company details. The technical opinion rating is a 72% buy with a weakening short-term outlook on maintaining the current direction. Of 9 analysts covering MO, 3 have a strong buy rating and 6 have a hold rating. Altria has a leading portfolio of tobacco products for U.S. tobacco consumers aged 21. Altria's wholly owned subsidiaries include leading manufacturers of both combustible and smoke-free products. In combustibles, Altria owns Philip Morris USA Incorporated, PM USA, the most profitable U.S. cigarette manufacturer, and John Middleton Co., Middleton, a leading U.S. cigar manufacturer. Altria's smoke-free portfolio includes ownership of U.S. Smokeless Tobacco Company LLC, USTC, the leading global moist smokeless tobacco, MST, manufacturer, and Helix Innovations LLC, Helix, a rapidly growing manufacturer of oral nicotine pouches. Altria also owns equity investments in Anheuser-Busch InBev SA/NV, ABI, the world's largest brewer, and Cronos Group Incorporated, Cronos, a leading Canadian cannabinoid company. Summary. While this type of strategy requires a lot of capital, it is a great way to generate an income from stocks you want to own. If you end up being assigned, you can sit back and collect the nice 7.03% dividend on offer from MO. You can do this on other stocks as well, but remember to start small until you understand a bit more about how this all works. Risk-averse traders might consider buying an out-of-the-money put to protect the downside.